Hi everyone, so today I'm with Dom and we are going to be doing a update video for Brookfield Corporation. In the past I did cover the company, but Dom and I were going to take a relook at this company and see what's really going on. Dom, whenever you're ready.
All right. Can you see my screen,
Perfect, yeah.
Matt? Cool. So we're just going to quickly kind of go over the company itself, like what they do, how they make money, and then kind of take a jump into their Q4 2025 results. So just taking a quick look at the company in itself. Basically, it's a massive global investment firm, and they kind of have like three main components where they get most of their money from. So the first one is through asset management through BAM. And so this is the part where they do lots of stuff with like pension funds, sovereign wealth funds, things like that. Um, I did want to note, because it is pretty important, that in 2022 they did spin off BAM into a separate stock, and then Brookfield Corporation, which is the company that we're talking about, owns a majority stock in it at 73%. So even though BAM is technically separate, it's still owned by Brookfield Corporation. So they still get most of the money. So it's kind of interesting because you can almost like double dip in that way because they own it still, even though it's not them, but it kind of is. So one way they make money, asset management. Next is Wealth Solutions. Think of this as when they basically are getting money from insurance and retirement services. And basically they're just investing in anything to do with like insurance and kind of just creating money from premiums and things like that. It says basically from steady long-term pool of permanent capital, basically, by doing it in this way. So pretty easy one to understand. And finally, their last one is operating businesses, and then they are the summary says real assets. So basically, this is them actually investing in like other companies or other physical assets. Some things that may be underperforming, so they can take them and turn them around and make profits off them. So some of the bigger ones that this mentions are renewable power. Um, it's one of the largest owners of hydroelectric, wind, and solar assets, infrastructure, physical networks of moving energy, data, and people. And then it gives examples of pipelines, fiber cables, rail, private equity. As kind of was mentioned before, buying unloved is what they call it, industrial or service businesses, and then using their managers to fix their operations, turn them around, make profit. And then finally, real estate. I mean, there's always times where real estate's going to be under, so it could be a good opportunity if you can get it on the cheap, flip it, make it profitable, things like that.
Yeah.
So that's kind of three main ways they make money as asset management, wealth solutions, and then operating businesses, basically assets. So not too complicated. So now we'll flip over to their Q4 25 earnings and see what those were like. So before I jump into this, we do have a very slight difference in kind of the term they use when calculating some of their figures. So they use something called distributable earnings. And basically, that is any type of money they've earned before or without unrealized gains included, because they have so many different facets of like where they can get their revenue from. It can make it kind of hard for investors to see the numbers. It's like make sense at the end of the day because they can have a lot of negative depending on like what they're investing in and things like that. And so it's easier for everyone to understand kind of how the business is currently doing in a more accurate way if they use the term distributable earnings instead of typical like revenue and earnings per share and stuff like that as it is. So just wanted to give that caveat before we got into this one. But let's jump into it. So they had distributable earnings before realizations at 5.4 billion or $2.27 per share, which is 11% increase in the year prior. Total distributable earnings is at 6 billion or 2.4 excuse me, $2.54 per share. Total net income is at 3.2 billion for the year. And then we're kind of going to dig into like all those other like subsections I mentioned earlier a little bit. So they have asset management distributable earnings at 2.8 billion or $1.17 per share. Fee-bearing capital increased by 12% over 600 billion. Fee-related earnings increased by 22% to 3 billion. Wealth solution distributable earnings is at 1.7 billion or 71 cents per share, a 24% increase over the prior year. Excuse me. Operating business distribution earnings is at 1.6 billion or 68 cents per share. Real estate leasing activities at 17 million square feet of office leases globally, with net rents averaging 18% higher than expected leases. Asset sales, 91 billion across businesses, including 24 billion in real estate and 22 billion in infrastructure. Carried interest realized 560 million in income or into income with 11.6 billion of accumulated unrealized carried interest. Shareholder returns, 1.6 billion returned through dividends and share buybacks. Dividend increase, 17% the quarterly dividend to 7 cents per share. And finally, insurance assets is over 140 billion with with expectations to reach 200 billion by the end of 2026. So I would say overall, actually pretty good quarter. Like I mentioned before, they do have slightly different ways of like talking about the metrics because they have the unrealized gains portion to kind of make it a little more palatable for like investors and understanding kind of how they're currently doing. But it's doing pretty good, I'd say. I mean, year over year, we're seeing lots of growth. Really nothing to complain about. So we'll ship it over to Matt, and we'll see how they're currently doing from a financial perspective.
Okay. All right. Thank you, Dom. Appreciate it.
Thank you.
All right. So, thank you, Dom, for the patience in that. I know it's a
So
lot.
much reading.
Yes. I imagine. So, uh, I thought I should also mention that I forgot to tell Dom as well that Bruce Flatt, which we did discuss about off camera, he is the CEO of BN stock of the company, and he's had an exceptional record. He's been compounding money for 25 plus years, from like 15 to 19%. So we'll probably do our own investor profile him in the future, but just generally like what he wants to transform into this company into Brookfield is he wants it to own the backbone of the global economy. He sees real assets that the world needs. He believes that the world will perpetually need more infrastructure, clean energy, real estate, and private credit, and the best risk-adjusted returns come from owning essential, irreplaceable physical assets that the government and societies cannot function without. So his three-part vision plan is build a permanent capital compounder, which is what Dom was kind of referring to before, or really he was with Berkshire Hathaway and annuities and insurance. That's very important. The second leg is scale the asset management flywheel. BAM. He sees asset management as the highest ROIC business on earth when done at scale. And then third is democratize alternatives via insurance. So through Brookfield Reinsurance, the vision is to tap massive pool of retail insurance capital that historically couldn't access private alternatives. This is the Blackstone BREIT model, but through reinsurance, long duration liabilities fund long duration real assets. The asset liability match is elegant in theory. So very important on what his playbook is, what his vision for the company will be. Now, with that being said, of course, we have to see, and I can't use AlphaSpread. I have to use a DCF, Claude DCF. I have to use an AI DCF because it's going to give me distributable earnings. You can't really use free cash flow to equity like you normally do because they have their own metric, like Dom was saying as well. Now, if we take a look here, I would say take more a look. This is more of a breakdown, a bear, base, and bull case. But if we take a look on the left side of the screen, we could see that the DCF model and assume that right now the shares are about $41, $42. On the absolute bear case, we're looking at $46, so that's about a 12% upside versus right now. The base case, which generally I like to use the base case when I do a normal DCF, uh, we're looking at $60, so it's a 46% upside. And then the bull case is 98% upside at $81. So we're still looking at a company that is undervalued based on all of the simple metrics I have put. I put 9% discount rate, 3% terminal growth rate, and a 5-year projection like I normally do. And these are just the normal base case scenarios. This is nothing I'm trying to rig or anything like that, or there's any bias. I try to be as unbiased as possible on this. Now, the next thing we're going to look at is their net income. And I know that they have their own distributable earnings, but just for the sake of argument, I like to look that it still has net income positivity or GAAP profitable, and it does. You have 2 billion and now it's 1.3 billion, so perfectly fine. I know it's a little down, but they don't look at really this, they look at different metrics. So with that being said, the stock is at 41 bucks a share, a little bit of a sell-off. We have a 52-week high of 49, a 52-week low of 29. So it's certainly on the higher side of it, of where it's trading at now. If you want, probably I would wait for a dip in the company because it's had quite a rally. Now, When we take a look at, I mean, I suppose we could first take a look at the future growth. I mean, Simply Wall Street, which Simply Wall Street, again, they don't use free cash flow, so it's very difficult to. This doesn't look right at all. There's no projection. It really looks wonky. The financial health also looks a little bit wonky here because you have a lot of debt, and of course that debt is going to come from the loans that they give out because they are in private equity. So that doesn't really tell us much about the business either. So you have to be a little bit careful about looking at these traditional metrics for the company. Uh, but lastly, we're going to look at Tipranks, and Tipranks is going to have a little bit of a different story. We're going to take a look: strong buy, 4 buys, 0 holds, 0 sells, and an upside of 40%. And I agree with that. I think the company is undervalued based on the DCF metric, based on tip ranks, based on everything else. It does look undervalued. And the more that we cover the company, Dom, I think it really looks like a good company and a good stock. What do you think?
Yeah, I'm right there with you. Honestly, I think it has a lot of good promise to it, and it's definitely worth keeping on a watch list.
Yeah. Okay. All right. Thank you, Dom. I appreciate it. Thank you, everyone.
Thank you.